Hi, welcome to another episode of the Investor's Guide to Hard Money Lending, brought to you by CoreLend Financial. Today, our guests are Jay and Arielle. They are two of our local investors here that use CoreLend quite a bit. So welcome.
Thank you for having us.
Yes. So I know we talk a lot about investing in the Birmingham market, the Memphis market. Y'all took a little bit of a different approach, but still local. You went right across the river into West Memphis.
That's correct.
Arkansas. Tell us about what made you choose that area when a lot of people did not, and what you did there and how it's worked out for you.
It's more about competition. Honestly. Memphis has always been more competitive, and nobody actually looked at West Memphis like they do now. Back when we started back in 23, and we scaled up pretty fast to how we are right now. So that was the main motive to go over there. And also, it's all about how you get the properties, how under market value you can get the properties over there compared to Memphis. Memphis is a really high ceiling when you try to buy any wholesale, any off-market deals, but in West Memphis is way better.
So elaborate on that a little bit more. Like, what do you mean by way better? So what would you say a 3-bedroom, 1-bath, because I know you'll have quite a few of those. A 3-1 you would purchase for how much there versus here?
Close to 10,000.
Yeah, I would say roughly around, if we're doing a 3-1 or a 3-2 across the bridge, it's roughly around, I would say around 10 all the way up to 30. Now compared to Memphis, if we're looking into that market, what would you say, Jay?
It's easy, 60,000.
60 grand.
And what is the difference in the rents?
Rents are pretty much the same. Rather than Section 8, Section 8 doesn't pay too much, so we mostly rely on corporate rentals or just retail renters. So Section 8 is not that high because they pay around like $900 for a 2-1, and it goes about maybe like $1,000 for a 3-1. So we rely more about retail tenants over
So what
there.
do your retail tenants pay over there typically?
Roughly around 13 all the way up to 15.
Okay.
So it's not bad.
Yeah.
It's not bad.
Not bad at all, especially when you're all into some of these for what, 70,000, 80,000?
Yeah.
Sometimes way less than that.
Sometimes way less. Sometimes, I think our lowest one, we were all in around 30 grand.
Wow.
Yeah.
So those numbers add up. When you want to talk about cash flowing, those numbers definitely start adding up.
Yeah, most definitely.
So I know, previously some people had issues maybe getting refinanced. How did y'all kind of bridge that?
So when we were trying to refinance, most of the properties were not to the mark in that area. Like when I say up to the mark, let's just say, for example, a 2-1 would probably be comped at $90,000. At tops, maybe $100,000. But now the same property is at $130,000, just 2 years down the line.
And you've helped build some of those comps.
Yeah, exactly. So that's basically helping us grow, build comps, and also refinance against the same comps that we already have. Yeah.
Which that's the way to do it. You're going to go into a market, and I'm guessing, Bart, some of the reasons why you might have issues refinancing is because so many of these lenders have a threshold where you've got to be at least around $75,000 financed. And so if you're only getting a $90,000 comp, then the issue is getting that loan for it.
Yeah, that's what we go through most of the time.
So typically, a lot of the times, if we to get around it, we'll buy in bulk.
Okay.
Yeah.
Oh, so you do like portfolio loans.
Yeah.
And that is a way that we've seen some of our borrowers refinance out. They'll do it as a package deal because they could still get that threshold where it's then say you're financing 150 over 3 properties.
Yeah. Essentially that.
So I know, like, of going over there, how have you picked what areas of West Memphis to go into? Like, I know there's a lot going on over there. You've got the Greyhound, Southland Greyhound Park. You've got all of that. So what areas do you look in? How do you source your deals, and where do you look for them?
Mostly northeast part of West Memphis, because those are easier to get in. Northwest, close to Marion, they're pretty good for the comps, and also little higher on the price point if you're trying to get in there. There are not a lot of off-market deals that you can get into in the northwestern part.
Because it's just not a big area either.
It's not a big area, yeah. Nobody wants to sell. They're like been there for like the last 30 years.
They're going to hold on to it, man.
They're going to hold on to it because they're cash flowing.
Yeah. Nobody wants to sell over there.
They don't want to sell it, so...
But no, that's been that because we've seen that over the course of the few years since you've done it. It's like it seems like it's getting easier for you to get the refinance, and you've got a proven track record. Yeah, I know probably CoreLend was a little nervous at first to start to do that over in West Memphis because of exactly what you described. Like there weren't the comps. Where are we going to find this? And I know probably a lot of people might not realize this, but in certain states, there's non-disclosure states and there's disclosure states. West Memphis, you're kind of flying blind a little bit.
Yeah, we actually started with CoreLend in the first place. Our first bundle deal. Mm-hmm. Yeah, which came through with CoreLend. So that's how we scaled, going with you guys. Yeah.
Yeah, because you tell them why you chose hard money versus something else, because you're able to scale. Like, how are you able to do that?
So when you come, so hard money helps us in such a way that, let's just say, I don't have to put too much of my own money in. Mm-hmm. I don't want to lock it up at a certain time, because there are situations where like CoreLend helped us in a deal where the whole interest was also rolled over into the primary loan. So that just helped us to scale and buy another property, which we were doing parallelly as well. So we don't lock up too much of our own money in one single deal, and we refinance it, get out of it, and do another one. That's how we did the BRRRRs in the start.
Yes, y'all were in the days when we could still roll in interest starting off that way.
Yeah.
We changed so we can't really do that, but
yeah.
You took advantage of it, and it also probably helped build that loan to be able to get it refinanced where there was more.
Correct.
There was more there. So tell me, on doing that, were you able to cash out on any of these? Or were it pretty much rate and term? Like when you went to refinance, were you able to get cash back at closing, or just
100%.
Every
single deal, we essentially just kept rolling over the proceeds to other deals. That's how we were able to scale so fast.
And that is the way to do it.
Yeah. Perfect BRRRR every single time.
And it allowed you, as being somewhat younger investors too, with not as much capital, to go in and then build it up through that. Now, I know we talked before when you came to one of our meetups too, where you were looking to kind of diversify into the Memphis area.
Yeah.
So what does that look like for y'all now?
Still scaling up. What would you say, Jay?
Yeah, we're still scaling up. We just got into more networking events so that we can find more deals over here. The most problem that we had, we also did wholesaling ourselves as well, like trying to source our own deals. That's our main concern that we see in the Memphis market, because there are a lot of wholesalers at the same time.
It's a pretty saturated market with the wholesalers.
I think that's been our biggest struggle lately, because it is such an oversaturated market that sometimes we would have to scout our own deals if we have to, or we'd have to rely on wholesalers with such a large assignment fee that the spread is too thin. So we couldn't really essentially make a move on that deal. I'm not saying the deals aren't there, but we're essentially just looking for the right deal.
Right. Some people get so focused on, I've just got to get the deal versus not the right deal.
Yeah.
And it takes patience, which y'all have. I mean, look how long you've been building up in West Memphis to be able to do it. And so when you say the assignment fees, what have you seen on some of these, like where it makes sense for these assignment fees? We're like, this numbers just don't make sense.
Yeah. You want me to go ahead?
You go ahead, Jay. Yeah.
Yeah. So there was one property in Memphis. I'm not going to give you the exact address.
No.
Yeah.
We don't want to speak negatively about anybody.
So yeah. So the property was actually taken under contract for $20,000. And the wholesaler was flipping us over for probably like $45,000.
So
making $45,000 on one assignment fee.
Yeah, it would be essentially like one got it under contract for this, flip it over to us. Between that spread, it was about $45,000. And based on that comps on that property, it was way too thin to where we'd actually break even on the deal. And the only profit we'd even make is probably $250 on that door.
Yeah.
Like $250?
$250 on that door. And the refi is just essentially paying back the loan, so it's a break even. Equity's still there, but still, we want something a little bit back into it. So, yeah.
And I think that's where we're kind of in a shifting market here in Memphis, though, too, because I think you're starting to see people, because I don't know if you've seen it, to where appraisal seems like they're not climbing like they once were.
Yeah, we've noticed that too. So we've backed off on a lot of deals. Comps are there, but it's like the appraisal just needs to hit that above mark just a little bit more to push it. But we just haven't been seeing that a lot lately. I don't know. So.
No, you're right. And so I think you're starting to see some of these values go down. I can even say, like, on our average loan amount, we're seeing it go down, even on some of these BRRRR strategies, because we're seeing where our borrowers, like, and we've worked with them, but it's been like they're having issues getting refinanced because the appraisal came in low versus what we even gave the ARV of 6 months ago.
Right. So
we actually had that happen.
Okay.
In one of the deals in West Memphis as well. So the CMA came in at 130 at first, but due to one of the properties which were sold under market, due to the seller reasons, obviously they just wanted to get out of it. That made the property go down in value in the 6-month period where we're trying to refinance. So that brought down the CMA from 130 over to 110, which affected our refinance rate at the end of the day. Yeah.
Yes, because those lower amounts financed too is higher interest rate.
Yeah.
Yep.
Because those lenders are still doing the same amount of work for just a lot less
Yeah.
dollar volume.
That's right.
Yeah.
So yeah, so we're seeing it. We're being a lot more conservative in what our ARVs are. We're looking. And what would you tell people, like, of what you want to, your ideal thing? Because I know a lot of people, like I said, with you being younger, people are wanting to get into this. What do the numbers look like to you of where the deal makes sense? Like, what do you want to be all into it for, and what do you want your rents to be?
Rents for 3-1, it's good to have at least like 1,250 to 1,300. The reason being, most of the properties in West Memphis are around 3-1, around like 140, 150, depending on the year that the property is built. So that's the ballpark range that you want to be in, because even if you're trying to do like a 75% ARV, you still end up with 110 to 120,000 in the loan amount. So the DSCR ratio is close to like 1.25 to 1.3. So that pays off most of the mortgage and also the insurance and taxes. Most of the mortgage, I would say. Yeah. So we're making a positive cash flow around, I would say, $300 to $400.
Which is great.
Yeah.
In this market, because our interest rate. So think about when those interest rates, if and when they do come down, and you have the opportunity to refinance, then you're really going to be cash flowing.
I think we're in the process of that right now, aren't we?
Yeah.
Yeah. We already hit our mark. We were just big a bullet and decided to start the refinance process on it.
Yeah. Actually, I want to shout out James, because he gave us a heads up on how to think about refinancing a deal.
You're talking about James Jones.
James
correct?
Jones.
Yeah.
Yeah. So the reason being, in our recent interaction with James, he brought up saying how, even though you have a property, you're sitting on it for a minute. We never thought about it. You're sitting on it for a minute and you never thought about refinancing it, but why not? And that's what we did. We did one of our refinance. We're in the process of it. We're just sitting on the property. We're thinking about like, hey, it's costing us money. You got to sell this property because it's not giving us enough rent or enough cash flow. So we did the appraisal. Initially, it was at 90,000, like I explained, the same scenario.
Now we have to 130,000.
Yeah.
Now.
That's a big swing.
That's a big swing.
Yeah.
So now we're cashing out close to like 20 grand on it. Just because, it's more than that. It's a ballpark at 20 grand. Just because we listened to one of our mentors. Yeah.
And that's what you have to look at. It's always that y'all probably see this. It's always changing. You can't say, this is what I've always done. This is what I'm always going to do. You kind of pivot with where the market goes and take advantage of those when you hey, the values are going up right now, capitalize on that.
Yep.
Because you don't know when that's going to go back down. And as long as the rent still makes sense, then it still works. But I look at, say, in a market like 38127 over here, for a while, that was just going up to where we could see a 165 ARV for 3.2 over there all day long.
Yeah.
Now it's already a year later, it's closer back down to like 135, 140.
It's true.
And I think a lot of that has to do with, you see, it also went down because you saw so many, you talked to property management, there were lots of vacancies over in 38127. So you had people that own these properties, they're not making them any money. They're sitting vacant. So they sell, and they sell just to get out of it.
Yeah.
And so then your comps keep coming back down.
Yeah.
But the rent still makes sense. So it's like now it's a time where you're seeing people go back into these areas.
Yeah.
So what got y'all started into real estate, into investing?
It's crazy. I'll actually tell the story. Initially, Jay and I actually met in college. And it was a group of us. We were all engineers, but Jay and I, what separated us from the group.
Now.
Yeah, we were both engineers. And what separated him and I, we were the only 2 people out of 8 of us to talk about growing and scaling outside of a job. And so essentially, what happened, man? We went somewhere.
Yeah.
I think, he was in Chicago. He called me. He's like, Arielle, what are you doing? I was like, man, I'm kind of in the process of buying a house. And I'm like, okay, well, he's coming back from Chicago. It's my birthday. And we put together a plan on the napkin. We still have it to this day about what we wanted to do. And we were the only people who were really open about our finances, credit score. It was like, well, let's just come together and do this. We're not doing anything, Jay. We just work and, what we're doing. We're not nothing more, nothing less. So I was like, I don't see any reason why we couldn't make it in real estate. So we came together and, went to a couple of networking events and Alpha Jack was born.
That is so cool. Now, do you still have jobs in engineering?
Correct. Oh, yeah. Yeah. So it's like utilizing what we have because the money is consistent and just investing it to make ourselves build more generational wealth for ourselves and our family.
And that is a key thing where a lot of people want to build generational wealth.
Yeah.
You're working your day job, you're doing this, but it's building something else.
Yeah, we're essentially just using it as a tool. Some people might use or say like a 9-to-5 is bad, but I mean, I don't think anyone's going to cry about consistent income in this economy, honestly speaking. So it's like you don't have to work it forever, but essentially use it as a tool to get yourself out of it. And so that's essentially what Jay and I have been doing for the past 2.5 years. And we're still going to keep growing. Like there's more to learn, but yeah, we just saw an opportunity to do it. So I don't see why not. Can't be scared of everything.
No, and that's where so many people. Yes, a 9-to-5, and I'm seeing more and more people that are starting much later than y'all did.
Yeah.
Of where they're seeing where they already lived through the recession of 2009. For all of that, they saw their 401ks kind of disappear, and so it's just diversifying.
Yeah. Can't save yourself to wealth, so you got to do something with it. So we put our all in onto real estate, and honestly, we've been self-set every single step of the way. It's just been him and I, and we just relied on what? YouTube and a dream.
YouTube and a dream.
YouTube and a dream. It was just us by ourselves.
Yeah.
We didn't have any help. We didn't really know where to go, and we just decided to bite a bullet on West Memphis, and it decided to work out for us. Nobody was looking in that area, so a lot of people were scared to get into that market. I get it. But
we were scared at CoreLend at first.
Of course, when you're kind of stepping into a market where it's like oversaturated, and there's been people that's been in this game for a long time, so obviously they get the deals. And so if we're just starting out from scratch and we're trying and we're scrambling, trying to find these deals in Memphis, but the numbers just aren't making sense, well, let's just go over to West Memphis. Nobody's looking at it. Might as well give it a shot. We took the risk. What do we have to lose? And our first deal was pretty solid, and then we just kept working on the next deal, the next deal, and the next deal. And the last deal that we did in West Memphis was probably our biggest. So yeah. And
so obviously you sat down and you mapped this out on a napkin.
Correct.
So obviously you've got so how did you come up with what your game plan was going to be? What's your end goal of that? How did you determine that?
It was just drunk thoughts and
just wishful thinking.
It's wishful thinking.
Yeah, wishful thinking is like, well, let's try wholesaling. Let's try doing this. Let's just try doing that. 90% of millionaires come from real estate. So I was like, well, let's try to get into this rental space, man. Let's see what we can do. So we put on a napkin. I think it was about 6.
Yeah.
Yeah, we put 6. It's like, okay, man, we're going to get 6 rentals by this time. No, I said 3. Mm-hmm. But he's like, nah, Arielle, you can't think like that. You got to think big. So I was like, okay, Jay, I don't know. Because it was my first time. I was nervous. Obviously, if you're jumping into anything new, there's a lot of uncertainty there.
Yes.
So I kind of had the safety net. I was like, I don't know, Jay, maybe we can do 3. He's like, nah, man, we're going to do 6. We did 6 our first year.
See? But if you'd only set the goal at 3, you've been like, 3, we hit it.
Yeah, we hit it.
And then we hit that mark by December, and then we just kept going. And yeah, we just haven't stopped.
And I think that's what you've got the momentum going. It's working. You keep doing it and keep building.
Yeah.
And I think some people, you're stepping into it. You're really nervous. Like this is where a lot of people, they've gone to, I don't know how many meetups, or they've listened to how many podcasts or on the YouTube, but they still haven't taken that step.
Information is just disguised as procrastination. Eventually, you have to take the jump. Everybody wants real estate. Everybody wants generational wealth, but how many people are actually doing it? There were people who in much larger positions than us, but way too scared to invest. Me and Jay didn't have the best credit scores. We had a couple capital, but we just took that chance. Our friends had way more money than us, but they were too shy and scared to. Wouldn't you say that?
Yeah.
Yeah.
And that's it's hard to take that leap because you think you were taught going up, go get your 9 to 5, get something to where you're going to work and not work 30 years like our parents in the same place. You're probably going to job hop to a few different companies. Not you. I'm just saying in general. Of what I told you before this started, I got my degree in sales. That's a area where a generation ago, the boomer generation, it was you'd be with the same company when you started and then you'd retire with. That is not the case anymore.
No, you got to leverage something. Like 9 to 5 is good. It's solid. It's a great foundation, but don't rely on it forever. Use it as a tool to get something for yourself, honestly speaking. So we just chose real estate as our business.
And it's a smart thing because I look at some of these people as they go up, look at what the cost of college is. Like a lot of people still have kids. The cost of college now versus when I was in the 90s and graduated in 2001. We looked at our daughter who just finished up her freshman year at Ole Miss. My husband graduated from Ole Miss. His whole degree, and my first career out of college was enterprise rent-a-car. Yeah, we'll pick you up. And you look, we made maybe 30,000 if we worked 60 hours a week that we worked overtime. But like my husband's degree that he got there cost a total of $25,000.
Wow.
And so that kind of made sense, even making that 27, 29. Now those same people, they come out of college making 50, but they paid over $100,000 for that degree.
Correct. Yeah.
So there's where real estate, doing some flips or having this cash flow, it's something where you're not impacting your day-to-day life.
Yeah. Yeah. Don't just rely solely on one. Have a dual income coming in too. I think it's really good. It sets yourself up. I don't have kids yet.
Right.
But I know my kids will be set. I got the investing part out of the way. We already got the hard part out of the way. Now we're just systemizing everything else to honestly step into commercial later on. Jay doesn't have kids yet, but I know he wants something set up for his family when he leaves this earth one day. We both are on the same mindset with that. And I think that's why we work so well together. I would think it's pretty hard to find a good partner like that.
No, yeah, very much so. And like you're out of creating generational wealth because you say 90% of millionaires, they invest in real estate. And that is not taught from a young age. At CoreLend, we're like, everybody can do it. You just if you follow the right mentors and the right processes, yes, you can. If you think, well, I'm going to go try my own thing, sometimes good luck. It may work out, it may not.
May work out, may not. But if there's a set blueprint in place that's already been proven, just follow that. Like, I would say stay in it long enough, you'll come up fast enough. Yeah.
And so tell me what's been one of your biggest learning lessons or a nightmare horror story that you've had?
Always check up on your
Properties.
vacant property.
Okay, what happened there? I'm sensing a
break-ins.
Not only break-ins, when it's cold and when it's freeze time, just make sure you just turn your water off.
Yeah.
Yeah. I know when you have so many to look at the same time, you tend to miss one or two. And that's what happened with one of the properties. Back in 23, when there was a freeze and all of the roads from Memphis to West Memphis were blocked off, it was iced up. We couldn't go over there. One of the properties had a eviction. So the tenant was moved out and we didn't go there. And then the freeze kicked in. We didn't ever turn off the water. By the time when we were over there a week later, that water's been flowing for a whole week.
It's been flooded out.
Yeah.
Yeah.
So I'm guessing insurance claim?
Mostly, yeah.
Mostly.
But still, those hurt, yes. And that's something that, a lot of people would understand. ICE, why can't you drive? In the Memphis, it kind of shuts down. In this area, it shuts down. We don't have the snow plows. We don't have the trucks to be able to plow. And you're going across two bridges that it's not going to work. But that is right. Winterize your properties. And even also, too, even if you have tenants in there, it's smart to go to tenants and tell them, hey, do this so you don't have a frozen pipe.
Yeah.
Yeah.
We send out reminders.
Yeah.
Every winter. Yeah.
Now, do y'all manage your properties yourselves?
Initially, we did when we had a few, but one of our property managers, Pam in West Memphis, Post House Property, she manages most of our properties right now.
Yeah, she does.
And that's where a lot of people get to as well, where the first few you have, we'll do it ourselves, save that money. But it gets, once again, y'all both have 9 to 5 jobs.
Yeah.
At some point it gets to make sense. It makes more sense to turn it over to property management, let them handle the day-to-day things with having to do with those properties so you can focus on either your current jobs or finding new properties.
Yeah, automation is key. when you have like so much of them. So our property manager helps out a lot, like with the heavy lifting and the way we're dealing with the tenants, the repairs and everything. That way we can focus on finding more deals and just our day-to-day jobs throughout our life. So it's been pretty good. I'd highly recommend it.
Yeah,
I would highly recommend, if you have a portfolio, please get a property manager.
Otherwise, you will get phone calls.
Oh yeah. Jay gets phone calls at 2 in the morning, man.
Yeah, 2 in the morning.
I was like, well, Jay, are we just going to continue to get phone calls at 2 in the morning, or are we going to have a system in place where that doesn't happen to us?
Had to go.
Because if I'm in a meeting and they call me, I can't pick up the phone. And if you're in a meeting, he can't pick up the phone. So I was like, I think.
And then you got somebody calling code on you.
Yeah, exactly. Yeah.
So I'm like,
we don't want to go through that. So
let's just automate it, and it's been a pleasure.
I know that's the way to do it. I mean, it's that way you can still scale up without it taking up. Yeah. It's the kind of the 80-20 rule. You've got 20% that cause 80% of your problems on those things. You don't let property management handle those.
Yes.
For you. So where's the next? Yeah, you said in Memphis. So where's your next deal? Where are you looking at your next deal?
Mostly outside of Memphis. We're looking into Birmingham, actually. Yeah.
Well, we're there too.
Yeah.
And there are some great, and I will say, like you say that, Memphis being saturated. Memphis has been on the radar for investors for probably the better part of a decade now.
Yeah.
Mm-hmm.
And just because the nature of our city, yes, but Birmingham, we have found that it's a very similar kind of real estate market as Memphis, but there's a lot more. It seems like there's a lot of opportunities there.
Yeah.
Where these numbers, where it's, hey, we can, because with the 100% financing, these numbers are making sense. Where you're still getting some properties for $40,000 and you're getting a $50,000 rehab, and then the rent's $1,400 a month. Well, you're all into it for $95,000, under $100,000.
Yeah,
it's pretty good.
Versus here in Memphis, it seems like we are constantly telling, and we tell agents like, don't ask for a price reduction.
Yeah.
But you're not having to in Birmingham as much.
Yeah, I was just talking to Derek this morning. He did tell me about like how busy it's getting in Birmingham.
Seems like we guys got some deals out there, man.
Yeah, and we're doing quite a bit over there, and but it's reminding me of what Memphis, where it's investors from all over the country that are starting to look in there too.
You gotta move fast.
You got to move fast, but there's still a lot, and the thing is, there's always going to be markets. Like there's always going to be opportunity. Sometimes it just gets where you've got to be a little more selective.
Yeah, that's true.
It's all about your buy box, honestly speaking.
Follow what?
It's all about your buy box.
Yeah. Yes, and don't get excited like I got to get this deal and it not be in your buy box.
Yeah. We had that issue at first because we were trying to get into real estate so fast, so quick. Yeah. The first deal was actually the same thing, like you just described. Like, we got to get on this deal.
Yeah, we got to do this. We got to do that. Felt pressured because we wanted our first deal. We wanted to tap into it. Obviously, we pay our rookie tax. Okay, we pay the rookie tax just like a lot of new investors. But we learned our lesson. And we never made that mistake again. So
yeah.
No, you just have to have patience.
Yeah.
We learned it the hard way.
We learned it the hard way.
And people typically do. Yeah, it's
the biggest lesson.
You talk about staying in your buy box. Any other words of wisdom for people just getting started off that are like, they don't, that are young, because you have a bunch of younger people that are, I want to get into it sooner. What is your biggest piece of advice from somebody that's, say they've only been in their career 1 to 2 years and they're already wanting to go into real estate? What's your biggest piece of advice?
For the younger generation?
Yeah.
I would say your age is your leverage, meaning that don't be afraid to invest your money because you can always bounce back from it. It's a lot harder when you get older, when you have like life gets in the way, kids. It's like take the risk now because essentially you can always make the money back.
You don't have as many bills.
You don't have that many bills. You don't really have a lot of, I would say responsibility right now. If you have the capital, I say go all in. And then by the time you look up, you're 30, you're already set, you're fine.
And that's excellent advice.
What would you say, Jay?
Also, if you're at like a 9 to 5, try to diversify your portfolio. Mm-hmm. Not only stocks, not just stocks or 401ks.
Because none of us are getting pensions.
Yeah. Yeah. So invest in real estate. It's better actually for taxes as well. Because if you're like a high income earner, mm-hmm. You get taxed a lot. Mm-hmm. Yeah. So real estate comes in a way that you can offset some of your taxes down at the end of the year.
So I'm hearing hire a good accountant too.
Oh yeah.
Yeah.
Most definitely.
Definitely get an accountant.
You need a good accountant.
Don't try to do it yourself. on some of these things with these write-offs.
Oh yeah.
You're
Get a good team under your belt for your taxes. You'll be fine.
Yeah.
Yes.
You'll be fine. But yeah, if you're young and just getting started, yeah, man, no. Yeah, just jump all in.
And I think that's great advice, because the sooner you do it, like you said, you can bounce back from it if you make a mistake.
Age is the leverage. Like, you have more time than I do. Like, I'm getting up there. Obviously, I'm not going to take as much big of a risk, but if I was 18, 19, or 20 getting into real estate, it's going to go. It's a long game for sure. Time's going to go. Time's not on your side. As I like to say, when anyone's like in their 20s, I'm like, man, you used to be 17 once. Now you're 21. What have you done with your time? So what are you doing to leverage yourself? You know, that way you don't have to, I don't want to work so much as a 9 to 5. That's okay, man. You don't have to. Leverage what you have now. And then by the time you look up, you're 30. Now you can go do, you can have the family. You can do whatever you want. You're good. You're set. You don't have to worry about anything anymore. So that's just kind of how I would think of it. If Jay and I started at 21, 18, 19?
Yeah, it would have been.
We would have been, it's okay though, but I'm glad we started at our right time. So no time is the wrong time. It's just what are you doing with the time?
You are exactly right there. And and the thing is, if you decide to get out, you can usually sell them and make a profit off it, or at least recoup your money.
There's always an exit strategy.
And that's what the key thing is too. Make sure you have an exit strategy.
100%.
Yeah, 100% on every deal.
Every deal.
You have to take that into account by the time you're signing the papers on the first.
How do we get out of it? How do we make more out of it? But yeah, it's been good.
Well, all very good advice. I thank y'all for coming on.
Yeah, it's been
And
good.
y'all, thank y'all for tuning in, and we'll see you next time.
Bye.